Okay, we are going to go ahead and get started. So, good evening, everyone. I am really excited about today's presentation. For those of you who do not know me, my name is Shantae Moore. I am a certified financial educator and I teach people how money works. So, welcome to tonight's special presentation, which is to highlight September 2021 right now. And every year, September represents Life Insurance Awareness Month. And I created this particular event tonight because I wanted to just really talk about the Life Insurance Awareness Month movement, which is created to help educate individuals and families about important aspects of life insurance. And at our company here at How Money Works, our mission is to eradicate financial illiteracy worldwide by closing the gap between those who know how money works and those who don't. We call those people who don't know how money works the suckers. So because of this, we're committing this month to focus on the important topic of life insurance, or what we actually call proper protection. So anytime you hear me say the word proper protection, I'm talking about all things insurance, life insurance, health insurance, long-term care insurance, maybe even disability insurance. But tonight we're going to talk about life insurance. But before we get into the actual talking about proper protection, I just want to start with talking about what do we start with? Because at How Money Works, our company specializes not only in financial education, but also working with families one-on-one to help them with their finances. And our approach to doing that is using a step-by-step roadmap which we know will lead you to financial security and independence. So we call this approach the 7 money milestones. And if you're interested in joining any one of our other free masterclasses to learn about all 7 milestones, definitely connect with me. I'll add you to my newsletter list so that I can invite you to future sessions which we do teach on a continual basis about the 7 money milestones. So you can email me at shantae.moore@howmoneyworks.com and I'll be sure to add you to my email list. But let's talk about tonight's milestone. Proper protection is actually milestone number 2 for an important reason, because I often get asked, I have a lot of people who will come to me and they'll say, well, Shantae, how can I want to improve my finances. I want to save more money. I want to invest. I want to, help put my child through college. I want to make sure I can retire. And the first thing that I talk to folks about is like, look, we need to actually address having proper protection first. And why is that? Because you need to protect yourself and your family from a future loss of income or savings before you even really start or continue your journey. Because at the end of the day, if something were to happen to you and you're unprotected, meaning you have no proper insurance, your family will essentially be left without your income, in addition to being left without you. And to be realistic, a lot of folks don't have a lot of money saved, for those unexpected situations that can occur. And if you're no longer here, your current savings, it might not be enough to take care of them. So it's a super important topic to address proper protection. And I'm glad that we have September to highlight it being Life Insurance Awareness Month so that we can have this important conversation. So one thing that, in the past year or so, I'm having so many different conversations with families because of the pandemic. And the pandemic has impacted all of us. Every single person has obviously been greatly impacted in so many different ways. And one of them is how we look at the importance of life insurance. Just to give you a couple of statistics. So in January, prior to the pandemic, only 36% of Americans who didn't already own life insurance said that, they plan to buy a life insurance policy within the next year. However, just a few months later in May, a few months after the pandemic really started, that number grew to 53%, just because people were concerned about COVID-19. And that's why it's important that we teach and that we each learn about what life insurance is so that we can make informed decisions regarding having that type of protection. So Protecting yourself, in my opinion, is more important than protecting your property, as Thomas Paine put it. You might not be able to fully protect yourself from illnesses or accidents, but you can protect your income and you can protect your wealth. And ironically, protection of your financial assets is called life insurance. It's a defensive strategy that's motivated by a sense of love, motivated by a sense of responsibility, or really even both of those can be motivators. So one question that we always get, and that we should address first and foremost is, how much life insurance should I have? It's like, okay, I know I need it. I know that there's a cost to it. We'll talk about that in a minute. But you really want to start with, how much should you actually have? Because the answer to that question is different for everyone, and it's totally different based on your situation. But however, as a general rule of thumb, we recommend that you consider having life insurance coverage that's at least 10 times your annual family income. So for example, let's say you earn $50,000 a year. You should consider having $500,000 worth of life insurance in coverage. And then you're saying, why? Why would I need that much money? Well, because you're replacing your income to your family. And if they received a $500,000 check from the life insurance company because you passed away, we can reinvest that money, and at a conservative 5% rate of return, that would replace at least half of your income. So, and that's just a rule of thumb, but I think, everyone should sit down and do a more detailed calculation of your family's need. And that's where you can sit down and talk with a financial professional. I'll share some resources at the end, but sitting down with a professional, you can talk about and consider other factors like, how old are you? How much debt do you have? What does your health look like? Your health has a huge impact on your ability to qualify for life insurance. How many dependents do you have? How many people rely on you for you to provide for them financially? Or what if you're a business owner? What is your role in the business, and what protection should we need to put in place, in case you're no longer here and that business needs to sustain itself in the future? And we just look at your overall financial situation to give you a more detailed calculation. So many people like Dana here, they didn't know that 10 times your income was just the starting point for protecting your income. And initially most people might think, well, that sounds expensive, but you need to look closer into it before you decide that you can't do it, because you'll actually be surprised. Life insurance is actually not that expensive. The same people who underestimate how much life insurance they need have a tendency to overestimate how much it will actually cost. And having both of those assumptions, it does keep a lot of families from actually putting the proper protection in place that they should have. So a statistic here, it says that at insure.com, it says only 59% of Americans have life insurance, and about half of those are underinsured, which means they don't have enough. Most people do not have enough coverage, if they have any at all. And so this is something that you and your financial professional should cover. You should talk about your short-term and long-term debts and any other outstanding loans, your financial goals, your mortgage, your rent payments, how old your children are, and how much their education could cost. And just like with so many things, life insurance, there's so many options out there. And, initially it can seem very complex. But once you know a little bit and a little bit more, it does become a lot more simple. So to start, it's important to understand that all life insurance usually falls into two basic categories, and it's either temporary insurance or permanent insurance. Now, trust me, I see so many people on social media and YouTube, and they talk about specific types of policies or specific types of life insurance. To me, that's a disservice to a lot of folks. There's only two types. It's either temporary, which we also call term insurance, or permanent. And there's actually 4 different types of permanent insurance, which we'll talk about a few of them today. So let's look at temporary insurance first. That's what, again, like I mentioned, what we call term life insurance. And this provides coverage for a specified period of time, like 10, 20, or 30 years. And term insurance is actually the most affordable life insurance that's available out in the marketplace because it has one core feature, and that's to ensure that if something happened, that a death benefit is paid out to the beneficiaries. And the death benefit is the money that's paid when someone passes away. And then eventually that term will expire. So that's essentially how term insurance works. But with term insurance, term life insurance, it's possible to have financial protection for your family or even your business for a relatively small monthly payment. So this can make it a fit for anyone if you have a very limited budget. Especially maybe in your time of life, you have a lot of responsibility. Like, for example, a family with multiple young children, that's a high financial responsibility. Or even like paying off your mortgage or college or running your companies if you're business owners. Those are high financial responsibilities, and term insurance will actually give you probably the low cost, most budget effective way to meet those responsibilities if something were to happen to you. But the question that we always get, we know the term insurance is for a set period of time, maybe 10, 20, 30 years. But what happens when the term on your insurance ends? So there's really two scenarios that you can look at. Now, scenario one is that if you don't have coverage anymore, you can just simply let your policy end, no fuss, no muss. Situations where this might make sense is like, for example, I talk to a lot of families, and we often will get a term life insurance while their children are young, maybe a 20-year, maybe sometimes even a 30-year term life insurance plan. But then, and because that's when their need is the most. Remember, when they're raising children, that's a high financial responsibility. But when the children are grown up and they're adults and they're self-sufficient, that high financial responsibility is gone. So they don't need to get another term insurance policy. They can just let that policy end. But what if after your term, you actually still need coverage, but you're still paying off like your home, or maybe you're a single income couple, or maybe you're supporting grown children or grandchildren, or you're still running your company. So for some of these reasons and many others, you might actually consider scenario two, which is keeping your term insurance policy. And if you're in good health or your term policy has what we call a feature called guaranteed insurability, you actually might be able to renew your old policy. So let's say you initially purchased like a 30-year policy when you were 20. Now you're 50 years old, depending on the life insurance company, you might be able to renew that policy at 50 for another 30-year plan. But the one thing to remember is that if that's something you're considering, is that if you want a completely new term policy, the biggest challenge is that you have to qualify all over again from a medical perspective. And if you can't qualify because you're 30 years older, your health might have greatly changed, the opportunity to renew or even get a new policy at that point, it probably won't even be an option because of your, and then let's say, even if you do qualify, that new policy will cost a lot more because you're of your age. Now you're older. In my example, now you're 30 years older. So the cost will adjust to being at a new age. And the general rule of thumb is that the older you are, the more expensive the new term life insurance will be. So on this page, this is what we call the financial X-wave. In your younger years, which is represented in the blue on the left, you typically have more responsibility, yet little to no wealth. You have a mortgage, you have children, you're paying student loans, again, you have a lot of financial responsibility. And at that same time, you're just getting started in life. Maybe you're just getting into your career. You're just, finding money to start saving. So we typically have little to no wealth when we're younger and on this blue side of the curve. However, in your later years, the yellow side, the plan is that you start to accumulate wealth over time, and your responsibilities will actually also decrease. So, the children have moved out the home, you paid off your mortgage, your income is now mostly available for savings. So term insurance is typically, like we mentioned, most useful when your responsibilities are higher and your wealth is lower, and that's actually left side of the curve. However, if these two factors flip later in life as planned, term insurance probably actually won't make sense to you later in, on the right side of the curve. And your financial professional will really help you look at how the X-wave can be applied to your situation. So I always tell folks it's not a this or that or one thing or the other. Situations can change. Term insurance might make sense for you now, but in the future, it might not make sense for you. So now that we know that, let's actually look at permanent life insurance. So like term life insurance, it provides a death benefit to protect your family financially. However, permanent insurance is designed to be kept and protect you for your entire life. That's why I call it permanent. It's supposed to last you your entire life. Most permanent policies go through age 120. So it's not just for a period of time, like with term insurance. So think of permanent life insurance as a lifelong strategy that can protect your family today. It can also help you secure your wealth in the future, but also have the death benefit that can provide to your family after you're gone. Now, I want to spend a couple slides talking about permanent life insurance because there's so many features and caveats that can be available to you if this is a type of policy that you're considering. So first of all, there are three important benefits of permanent life insurance. So number one is obviously you have the life insurance protection for your entire lifetime. You don't have to worry about renewals. As long as you're properly funding the permanent plan, it should last your entire lifetime. The second important benefit is that with permanent life policies, you can actually add long-term care as an optional rider. We'll talk about that on the next screen. And then number three is your accumulated cash value, which can give you flexibility with the premiums. So what that basically means is that if you have a moment in time where you can't pay your life insurance premiums for any reason, the premiums can actually be paid out of your accumulated cash value. And other benefits that can be included with the permanent life insurance strategy can be advantages like absolutely no market risk, growing that cash value at no market risk. You can have some long-term care coverage, which I talked about, and we'll talk about a little bit more. You can have tax-free growth of that cash value that's accumulating. And then eventually you could pull out that cash value and have tax-free income in the future, which ultimately creates a tax-free legacy because any life insurance policy proceeds are completely tax-free to your beneficiaries. And avoiding taxes is extremely important. Trust me, you want to avoid taxes as much as possible when it comes to wealth. And it's extremely important to consider because it can directly and significantly impact how much money you'll live on in retirement, but also the amount of money that you are able to leave to your heirs. So let's talk about what the cash value component of life insurance is and why it can be so important, because I think a lot of folks are misguided about how to leverage permanent life insurance and also use it to where you can accumulate this cash value. So when you have a permanent life insurance policy, a portion of your monthly premium is set aside in an account that grows over the life of your policy. And the money in that account is your cash accumulation, and that can be used to fund future purchases. You see a few possibilities on the screen here. And in addition to having no market risk and tax-free growth and income in the future and legacy, as I had mentioned before, life insurance cash value can also be creditor proof, meaning creditors can't come after your money that's accumulated inside the permanent life insurance policy. And so when you look at all of those benefits together, the advantages of the cash value benefit are very, very important, but also very powerful. And again, this is a properly funded policy. That's a whole other webinar, but if you work with a proper financial professional, they'll make sure that you're putting enough money in. They'll make sure to disclose all the surrender and penalties. Those are things we want to avoid. But if you properly fund this policy, the cash value can work out so well for you in so many ways. So I talked about long-term care a couple slides ago. This is super important because this can also be added to a permanent life insurance policy as a rider. And I just want to take a moment to really just talk about the importance of long-term care insurance for a moment. And you might not know this, but 70% of people age 65 and over will need some type of long-term care services and support, at some point in their lifetime. So in other words, statistically, you and I we will very likely need long-term care. But here's the thing, only 8% of people over age 55 have purchased long-term care insurance coverage. And that sounds like a possible problem and an expensive problem that's waiting to happen. And it is a problem. Because when we talk about long-term care insurance, that coverage helps cover out-of-pocket long-term care expenses that can really add up. If you had a long-term care benefit coming from your life insurance policy, and if you trigger that benefit, that money that you would receive, it can be used to pay for qualified services like nursing home care, home health care, assisted living care, or even adult daycare. And you never know if or when you actually might need it. And if you do need it, the average long-term care need, if more than 1 year, it lasts actually on average 3.9 years. So you can see that, and I can't tell you how many stories of clients that I've worked with who are experiencing helping others, helping their parents, helping their loved ones handle long-term care needs. And it can be very tiring and taxing on you emotionally, physically. You want to look at this so you don't have at least the financial stress that comes along with it as well. So as you can see here, the average total cost, can be super expensive if it's not covered by a policy. And the cost without long-term care coverage, what would end up happening is that you're going to drain one or more of your savings that you were planning on using for something else for the future. Trust me, I'm telling you, I've seen it. And some people think, oh, well, long-term care insurance is only for a certain type of people. No, I have clients who are very wealthy and they opted not to take care of this. Something happened to where they needed long-term care and now they're paying for everything out of pocket because they said, oh, well, I have savings. I'll just pay for it on my own. And they're literally draining all of their savings. They're not living the life that they thought they could because the money is now being redirected to long-term care expenses. And had they got the coverage that they needed, they would have been able to protect their savings that they can use to live the life that they want to in the future in retirement for their family. It happens so many times. That's why I'm harping on it because it's so important. Um, so now that you're probably like, okay, Shantae, I get it. I should probably figure out how can I meet this long-term care need. Well, there's a couple options that you have that you should look at. The first option, which I don't recommend, but I want to just at least educate you about it, is having a traditional standalone long-term care policy. And even if you don't have life insurance, you can actually go directly to an insurance company to purchase a standalone LTC policy. Or your second option would be to actually add a rider to your permanent life insurance policy. And if it's available for your permanent life insurance policy, you can add that LTC protection at a little bit of a fraction of a cost. Literally, like, let's say your monthly premium is $50, you might be paying $4 to $6 extra to have that long-term care benefit. Is so worth it. And I recommend anyone, if you have a permanent life insurance policy, look into that and see if it's actually an option. So here's the thing. If you go option one and buy a traditional standalone policy, there are a couple things you should know. First of all, the way they sell those policies is that your premiums will start low. But over time, insurance can raise rates on them, and they do raise rates. I've seen clients, maybe they bought a policy 10 years ago, and then now the premium is almost double because the insurance company keeps going up in price. And then also, you usually have to pay for care up front and out of pocket. and then you get reimbursed. And that can be hard for a lot of folks because they don't have the money up front to pay for something like that, especially during a difficult time. And another thing to keep in mind with the standalone option is that you could spend thousands on premiums and get nothing back in return. Because remember, although there's a 70% chance that you'll need LTC, there's also a 30% chance that you won't need it. And I hope all of us fall into that latter category. But with the traditional standalone policy, let's say you were, trying to be proactive and you bought a policy in case this were to happen. But what if you ultimately never ever need it? You pay money into something that you won't be able to recoup at all because you never qualified for it. So when we talk about option 2 and choosing to add a long-term care rider to a permanent life insurance policy, a key advantage of this option is that insurance companies typically don't raise rates for life insurance policy holders. It's a contract. Once you're locked in at a certain rate, those are the rates. And then some insurance companies, after there's a waiting period, let's say you did, qualify for long-term care, you trigger the benefit. Normally there's a waiting period where you have to pay your, money to cover long-term care expenses. After the waiting period, you will receive money from the life insurance company to pay for long-term care expenses. And you can spend that money however you choose to. Most life insurance companies will not require you to submit receipts so that you can get reimbursements. You don't have to say, oh, I'm spending the money on this thing. You can spend it on whatever you want. As long as you qualify for the long-term care, just triggered the benefit. So when you have life insurance protection and long-term care protection in one plan, that can be a huge savings to you in the long run. And again, but let's say you get the life insurance, the long-term care rider, and you don't need it. Maybe you're the 30% who doesn't need it. Your premiums aren't wasted because your premiums were still going to pay for the life insurance policy first anyway. And instead, your family receives a larger tax-free death benefit. So long-term care riders, they aren't the only riders available on a policy. You can also consider other living benefits like critical and chronic illness riders. Those can really help save the day. Like if you face any major health challenges, like some of these you see on the screen, critical illnesses would be something like a heart attack, a stroke, cancer. A chronic illness would be something like ALS, diabetes, Alzheimer's. So you should discuss looking and see if these riders are available to your permanent life insurance policy with your financial professional. Because again, having these riders are super inexpensive. Some life insurance companies even add these type of riders for free. They build it in automatically into the policy. And I'll also say one more thing is that some term insurance companies, some life insurance companies with their term life insurance actually have similar riders as well. Super minimal cost, or it's built into a term insurance. So these are benefit riders, the critical and chronic illness riders that you definitely want to talk whether you have term insurance or are planning to get permanent insurance. So this was a quick workshop tonight that really just highlights our spotlight. That's it for our highlight on proper protection for Life Insurance Awareness Month. I hope that you found this information to be informative, but also thought-provoking. So to close, before I just kind of end the session today, I just want to give you 2 practical steps for you to take a look at. Now, first of all, number 1 is a way to start thinking and taking control of your finances. Because as I mentioned, having proper protection is only step 2 of 7 money milestones. What about the other 6 money milestones? That's what we work through to help families control their finances. And the first step that we do that with is completing what we call a money discovery worksheet. This is really for you to just get an idea of like where you are right now financially and where you want to go. It's the same thing, that's how you really lay out your financial roadmap. This How Money Works discovery is in the How Money Works book. If you follow me or watch anything that I teach and talk about, I always talk about the book, How Money Works, Stop Being a Sucker. You can request a complimentary copy of that book from my website if you don't already have it. But this particular worksheet is actually in 2 pages in the back of the book. And then, of course, I always recommend take that information from the worksheet and share it with a financial professional so that they can look at it and help to make sure that you're on track to meet your financial goals. And if you don't have a financial professional to talk to, contact me and I'll be happy to help you with that. And again, I'll be also happy to give you a copy of the book. I do have that worksheet in the PDF as well. So, and lastly, I would just say after this session, you might have some questions that come up that maybe if you really just looked at how life insurance or not having it applies to your current situation, you might have some questions. You might be asking yourself like, man, how much life insurance do I really need? Or what type of life insurance is actually best? Is it term? Is it permanent? Is it a combination of both? I have both types of permanent, I have both types of life insurance myself. Or again, if you're interested in getting a copy of the book, feel free to reach out to me through my website. I'll post a link to that attached to this recording, and let's help get you some answers to those questions. So I just want to thank you all so much for attending this special Life Insurance Awareness Month session. And I definitely hope to see you in another How Money Works Masterclass. So I will talk to you guys later. Bye now.